And while debt to GDP was so much lower in 1980, it was lower than any time before World War II from since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980 they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders because this time the gains of 1980 will be held and exceeded.
The story most people hear about silver's run to $50 in 1980 is simple. The Hunt brothers cornered the market. Rafi Farber says that version is convenient, but it isn't accurate. The Hunts played a part, sure, but their role was small compared to the real driver. What pushed silver into the stratosphere was a collapsing dollar and a Federal Reserve in panic mode. The Hunts flying in silver from Switzerland may have added some fuel, but the fire was already burning because the currency system itself was under pressure. Critics today argue that using 1980 as a benchmark for where gold and silver could go is misleading. Farber agrees, but not for the reasons they think. He says this time is worse. Back then, the dollar was in trouble, but the system itself remained intact. Now, with government debt at historic highs and trust in fiat paper fading, the foundations are much shakier. To understand the difference, Farber points back to what the Fed could do in 1980. Inflation was raging, so the central bank hammered interest rates, slashing at times, then forcing them up into the mid-teens. That pain eventually broke inflation's back. Consumer prices cooled, and confidence in the dollar returned. The key, Farber stresses, is that the Fed still had credibility and firepower then. They could restore trust by proving they were willing to act decisively. That's why the fiat system survived. Today, he argues, the Fed doesn't have the same room to maneuver, and that changes everything. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
People tell me, you can't compare to 1980. That's not fair. That's when the Hunt brothers bought all the silver, and that's why silver had $50 because of the Hunt brothers. It had nothing to do with them. Maybe it had 0.5% to do with them. Very, very little. This is one of those things where the mainstream media attaches itself to a certain narrative to hide the fact that the money was collapsing and blame it on two guys who were shipping silver in from Switzerland on airplanes. I'm sure that affected the price somewhat, but the fact is that the dollar was in total freefall and the Fed was in a panic. But the people that criticize me and say, well, you can't compare to 1980, you can't just use 1980 as a metric and then imagine that gold and silver are going to go back to where they were and use all these ratios to say what's the 1980 price in 2025, blah, 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 blah. Well, they're right. They actually have a point. It's not fair to compare to 1980 because this time is going to be a lot worse for the dollar, but better for gold and silver, and better for stackers, and better for the end of the fiat monetary system. You know, 1980 was pretty good for the end of the fiat monetary system, but it wasn't good enough because it kept going, and it's still going today. But this time, it won't, and here's why. What are the main differences between 1980 and now, and why will the dollar necessarily, that's, a relative term. It's not really, but it's not a good term to use in these types of content videos. Why will the dollar probably collapse entirely this time when we reach 1980 conditions when it didn't in 1980? Well, let's go into that right now. And by the way, before this happens, you can get your gold at Miles Franklin. Check the link in the description below and mention the Endgame Investor. And you can take your gold and silver and you can put it in a dirty man safe. Use the code ENDGAME10 at checkout for 10% off. Low tech is good tech. High tech is dangerous. And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here and then back up. Blah, blah, blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising. They were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, but we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the US inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So, in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year.
Rafi Farber points out that in late 1980, the Federal Reserve wasn't just watching consumer prices like it does today. The focus was on monetary aggregates, M1, M2, M3, the actual growth of the money supply. Inflation originally meant too many dollars being created relative to real backing such as gold. When the Fed saw that money supply growth was running out of control, they responded with extreme force, driving interest rates up to nearly 15%. That aggressive move worked. By choking off the growth of monetary aggregates, they eventually slowed consumer price inflation, which in turn cooled gold's rally. Once the Fed had proof that money supply growth was back in line with their targets, they began cutting rates. The important point, Farber says, is that the Fed still carried credibility, and more importantly, the system itself could handle such hikes because overall debt levels were low compared to today. This is why he argues that people who dismiss comparisons to 1980 are right, but for the wrong reasons. It's not because silver's spike back then was some anomaly driven by the Hunt brothers. It wasn't. The real difference is structural. In 1980, the Fed had the tools and the breathing room to defend the dollar. Today, it's the opposite. Debt is massive, fiscal deficits are entrenched, and raising rates aggressively would collapse the system instead of saving it. That's why Farber says the present setup is far more dangerous than anything the world faced in 1980. Let's get back to the interview.
According to a staff analysis, says the Federal Reserve Board, the demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace than they wanted. The monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care, it wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that. Once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price. But this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension. And then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate, and you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
What really emerges from this comparison is how much weaker the ground has become beneath today's monetary order. In 1980, the central bank still had the credibility and capacity to shock the system with sharp policy moves, and the economy could withstand the strain because overall leverage was relatively low. That backdrop allowed confidence to be rebuilt, even if it came at a painful cost. Fast forward to now, and the conditions are entirely different. Government obligations are at levels that make dramatic tightening unthinkable, fiscal discipline is absent, and the faith that once anchored fiat money is steadily eroding. Silver's earlier surge may have been dramatic, but the environment it played out in was still one where the system itself could be defended. The danger today is that the same playbook would break the very structure it's meant to protect, leaving no safety valve to restore trust once it's lost. If the old remedies are no longer viable and the currency framework is far more fragile than before, could this cycle be the one that forces a genuine reset rather than just another painful correction? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.